Toronto's unsold condo crisis is breaking records. Both pre-construction and completed but unsold inventory is at all-time highs. This is not just a Toronto story. Steve Saretsky did a great video on this for Vancouver. He talked about the price gap between new and resale and how it's brutal. Developers can't come down to the market clearing price to compete. This is why we're seeing a lot of developers, especially in the Vancouver market, wanting to bring back that foreign buyer bid. But today I'm going to focus a little bit more on Toronto, and then we'll scan a couple of those other Canadian markets. Who is most at risk per capita and relative to population growth? So I'm going to start here with a chart that I've already presented, but this is from CMHC. It shows that Toronto has a record high number of months of supply for pre-construction condominium apartments. Recently hit 57.4 months. And I'm going to dive into a post by Chief Economist and AVP at Central One, Brian Yu, who posts great analysis on LinkedIn and Twitter. I'm going to have him on the YouTube channel soon. We have an interview scheduled for the next couple of weeks, so I'll get that out as soon as I can. When I have him on, we're actually going to be talking about another analysis that he did for rental supply, which is another huge risk from my perspective, as I've mentioned a couple of times on the channel. But basically, he built this series of charts that shows new and unoccupied units by select metro. And you can see a lot of markets have these kind of hockey stick graphs, but a lot of them don't. So there's not a huge risk in a lot of these markets, or a lot of the risk has gone away because this excess supply has either been sold off or they've slowed their building. So let's start by looking at Toronto versus Vancouver. So the biggest things that I observed in this data set from Vancouver and Toronto is that Vancouver has the most unsold condos with 4,200. By a large margin, they have the most unsold condos, followed by Montreal with 3,000, and then Toronto with 2,800. So this is a pretty bad setup for the construction industry that relies on a lot of these projects to continue. But the research that I'm going to cover with Brian Yu actually shows how a lot of that activity is getting backfilled by residential construction through rental apartment. And basically we're seeing homeownership or homeowner built product basically being erased and backfilled with rentals. So the whole you'll own nothing and be happy thing might ultimately be getting truer every day. Toronto's numbers have come off their highs pre-COVID. And a big reason for this is Toronto has really figured out how to pre-sell condos. They have a strong pre-construction market and pre-sell a lot of those units. You can still see that big jump up that urbanation is observing. Vancouver saw the same thing happen, 14, 15, 16. There was a big pileup of unsold units, and then it gradually got absorbed, dropped out. You saw a little bit of a bump during COVID, but Vancouver has really jumped up to about 4,000 units now. One of the things Steve talked about in his video is that most of this developer inventory never hits MLS. But the other thing about pre-con is that it catches that excess demand. If the resale market is oversubscribed and there's investor or speculator capital that wants to get into the market, they can go into that pre-con market and buy products priced higher than resale, overpriced. They're given a speculative option where they can buy a contract to close on that unit in 4 years. So they don't actually have to own the unit today, cash flow it, run it as a rental property. And if they're bullish, if they think that the unit will appreciate in value, then it'll grow into its value. So you're basically getting a forward-looking contract. But today we don't have any excess demand, right? We have excess supply. And so there is no excess demand to spill over into that pre-construction market to absorb those units. What Steve mentions is people today, if they want to buy, they're going to buy one of these unsold units, or they're going to buy a resale unit because the economics of that is far better. And frankly, the economics have always been far better, but people like creative speculative options. And so they took advantage of it. As Steve put it, the pre-construction model is effectively breaking down. A lot of developers are pivoting into that rental construction world where they can build the same product. Their revenue is a little bit different rather than manufacturing a product and selling it. This would be like GM manufacturing cars and then leasing them out. Developers can do the same thing. A lot of developers don't want to do this. They don't want to ultimately own the units. They've figured out the mechanics of building and selling, but most of them aren't really left a choice in today's market. So the ones who want to keep building, keep the machine running, and keep liquidating the land pipeline and asset pipeline that they have are moving in that direction. This is why we're seeing a record number of rental housing under construction. I'll use this as an opportunity to pivot to the report that Brian sent me that we're going to discuss on the YouTube channel when he comes on for an interview later this week, which shows how much activity is actually happening from a rental construction perspective. This chart here shows CMHC rental market construction. So you can see we've basically gone from building very little rental units to building a ton, and rental construction as a share of the total market is the highest that it's ever been. right? A lot of construction jobs depend on this rental model working and continuing to work. And there are risks associated with that because real estate is such a long run supply. There's a bit of a whipsaw. When demand's really low, you don't build a lot, and then demand piles up and you build a ton to meet that excess demand. Not all the market participants are talking to one another and nobody knows how much supply is coming. And then that demand gets filled and now all of a sudden you've got excess supply situation. And so this is how real estate can really ebb and flow from excess demand to excess supply very quickly. By quickly, I mean over the course of like 3 to 5 years, but it can happen more so than other markets because of that long run. Like if you contemplate a project, you might be underrating a project today in a 2% vacancy market, and then you go and build it, and 4 years later, it turns out 1,000 other people said, oh, 2% vacancy, this is a great time to build rental. And then 4 years later, after you've developed, built, and rented out your project, you're in a 7% vacancy market and rents are down 10%. This is where the risks are associated from the multifamily perspective. Now, let's zoom out on this a little bit and see and take a Canada-wide look and really think about what stands out to you here. They've been really good at covering every single market. The big absolute overhangs are Toronto, Montreal, and Vancouver, with the biggest volume or total number of outstanding units. If we go back to the actual trend, the markets where you can really see a notable climb, I think Ottawa-Gatineau would really stand out to me. St. Catharines as well, where it's basically like a hockey stick graph. One of the things in St. Catharines is they have ADU program. They have a grant for garden suites and a fast track program for garden suites. So a lot of people are building garden suites and multiplexes there. There's also a lot of CMHC MLI Select multiplex or mid-rise projects under construction. And then the other one that stands out to me from a fastest riser perspective is Kelowna. Kelowna has been pretty volatile, so I would take it with a grain of salt, but it had the same pattern that we saw that I mentioned in Vancouver, Toronto, that big spike 16, 17. That was the last time we saw a rate hiking cycle, by the way. You saw a combination of factors. So you saw foreign buyer tax in BC, foreign buyer tax in Ontario. Then you also saw the B20 stress test was added to the market. Then you saw the big spike during COVID, and then it's kind of just been slowly ticking up since then. And again, it's been pretty volatile, so I don't know how much I would count on this big spike. Peterborough seems like a market that's been relatively stabilized from a supply perspective. And St. John's basically saw that huge spike and then has since dropped off. St. John's has been a really interesting market. It's seen crazy year-over-year price growth. Boomers from more expensive markets actually go there to retire and snowbird because it's one of the cheapest and most beautiful places to do that. These smaller markets are more fragile and volatile if starts fall or if vacancy rises or rents fall. The absolute numbers here can hide risk. Per capita, I would say, is probably going to tell you how heavy the overhand feels relative to local demand. Obviously, Toronto, Vancouver, and Montreal are going to see the highest sheer level because they're the biggest cities. But I also broke this down by basically adding in the local populations for each market. Your highest risk market is Chilliwack. So a lot of risk, I would say, on a per capita level on the West Coast. Some of this gets immigrated away from places like Edmonton. I would still consider Edmonton to be a relatively high risk market from an overbuilding perspective. There's a lot of Toronto pre-con capital piling into that CMHC MLI Select program there. But your Chilliwack and Kelowna, I mean, your two BC markets, BC really hasn't seen a ton of population growth. It's just above zero. Ontario is seeing negative population growth right now because a lot of people are leaving from interprovincial migration. And basically the temporary foreign worker and international student tap has been shut off. My guess would be probably that the government will want to start seeing some sort of immigration starting in the next couple of years. But will it be temporary foreign worker and international students? Probably not, because they've committed to that number coming down from 7% of total population in Canada right now. So non-permanent residents are going to go down from 7% to 5%. So they need a 2% drop. It's like 800,000 people. A lot of those people are moving over into that permanent resident stream, but a lot of them are also leaving on their own accord because they're not happy with the economic prospects right now, or because their visas aren't being renewed. And so, while Edmonton has a little bit of the risk can get softened a little bit by the population growth that we're seeing in Alberta, the other notable ones that are high here on a per capita basis, Chilliwack being the highest, Kelowna, Abbotsford, Mission, BC, Vancouver, and then you get to your Prairie, Saskatoon, Calgary, another BC, Victoria, and then you end up in Ontario on the East Coast, so St. Catharines, Fredericton, London. Toronto falls pretty low on the list here. From a unsold units per capita by city, Toronto's actually not massively overexposed by comparison to a lot of these other places. Even though Toronto does have this record flood of new units coming, they're sold units. that presents its own risk. Like a lot of those units are going to have trapped liquidity. They're going to be cash flow negative. They're going to be equity negative. The rents are probably going to be a lot more negotiable to fall down. But from an unsold unit perspective, there's not a ton of inventory sitting stale in the market in Toronto. So let's talk about the knock-on effects of something like this. Urbanation mentions it pretty well in this report, and they show how it's not just the inventory. Obviously, developers sitting on inventory, that's money that's trapped in their projects, right? So that's money, and CMHC observed this as well, where they showed that we have a record number of months of supply for pre-construction condominium apartments. So if developers can't clear out their existing inventory, that's profit trapped in the project. And that's profit they might have used as equity in their next project, which means they're not going to move on to their next project. It's going to be pretty hard for you to convince your investors in your project to put capital in the next project if you still have a bunch of unsold inventory. Like think about any other retailer. If you can't sell product A, why would I go and fund product B? Urbanation put out this report that shows how the slowest condo market in over 30 years, if people aren't buying pre-construction units, then builders aren't starting to build pre-construction projects, which means construction is going to slow. This is a huge issue for the future construction pipeline. Will this eventually create a supply gap in the GTA market? I understand the idea that a lot of people think that this will later create a gap where there won't be any supply built for 5 years, but we are seeing a lot of that supply being created through rental rather than ownership. Will there be an ownership supply gap in 5 years? Probably, if population growth ramps back up and we end up with another excess demand scenario. 5 years, maybe a little bit optimistic, but in 10 years, likely. In the meantime, a lot more housing will get created through this CMHC MLI Select rental housing stream. And so, again, we're going to see more and more rental units added to Canada's housing stock and fewer ownership units added to Canada's housing stock with a lower and lower home ownership rate. And the Statistics Canada's home ownership rate has fallen significantly from 2011 to 2021, which was our most recent census. You can see that Canada's homeownership rate has been falling. It's especially bad with younger generations. And I talked about this in my most recent video about how youth unemployment was going to become a longer term issue as young people can't start entering the housing market if they don't have jobs. Speaking of jobs, let's really get into that knock-on effect. Urbanation mentioned these project cancellations mounting, construction starts collapsing, and Statistics Canada just showed 22,000 jobs lost in the construction sector, or a 1.3% drop in construction employment. That's the pipeline stalling in real time. And policymakers are very reactionary. I'm sure they're going to try and do something about this when it becomes a big issue. I don't know when they're going to realize that it already is. Now, here's the twist. I mentioned a lot of times that we're going to see more and more rental supply, and that was going to push rents down. I call it a risk for the real estate market, which is my clientele. But for the end consumer, and a lot of people watching my videos on YouTube, this is a good thing, right? That's housing affordability being created. If rents are falling, then that's making housing rents through rental more affordable. If ownership units are not being created, it's not really solving the home ownership or housing affordability from the ownership side of the equation. And that's the challenge that a lot of people have with the policy direction we're headed right now. So what does this mean for investors, policymakers, market participants? In the short term, I would say you're going to continue to see soft presale demand. You're going to continue to see incentives. Urbanation also put out a report that 2/3 of rental landlords are offering incentives right now. This means that we're going to need to see more price discovery in the resale and pre-con markets. In the medium term, probably we're going to see fewer housing starts and probably more job losses as a result of contraction in the construction space. Long term is, this potential risk of another supply crunch if we don't figure out how to create more housing efficiently. Or the alternative is we do build all of those units that we have contemplated and that CMHC says that we need, but a lot of those units end up getting created from rental. We have to listen to more of these WEF folks talk about how we'll own nothing and be happy, and everyone will be in our comments talking about how homeownership's been erased. I know a lot of people think that the death of homeownership is some fundamental pillar of the Canadian dream. We can talk about that another time. I've always found it funny that people think that homeownership is like some sort of fundamental of freedom for people. And I would agree in a lot of places, but in Canada, where you have to pay land transfer tax, property tax, development charges, and the CRA can lien your house if you decide not to pay them income tax, I would actually say that owning a house is less freedom than being a renter, where you can move around. You don't have to pay anybody to buy or sell your unit. It's way harder to evict you. It's literally easier for a bank to evict you in most jurisdictions in Canada than a landlord. And I actually think that more and more people are warming up to this idea that rental might be okay. But generally, we are shifting, and this is just an observation, it's not a judgment. We are shifting way more towards rental supply than we are to ownership supply. This is a trend that I expect to continue until we either get that pre-construction buyer or investor speculator bid back into the market, because it's such a necessary thing. It's a necessary evil for us to get housing units created, because you need that person to commit to buying that future house for builders to feel comfortable doing it. Or we completely blow up and reconfigure our capital raising system in Canada and start allowing for US style crowdfunding or capital markets deals where projects can be properly bonded or built on spec, and builders can start building more in a more capitalistic fashion the way that they do in the US. And we have banks and builders taking the risk, not pre-construction buyers. So all in all, this unsold condo problem is the biggest housing story in Canada right now. Vancouver is obviously experiencing it the worst, but on a per capita basis, other places on the West Coast are actually seeing it even more severe. So watch Steve's video for the West Coast angle. And nationally, I would say there are several metros flashing red on a per capita basis. I'm watching the prairies closely right now because while they are seeing so much population growth, they are also really good at meeting the demand that they're seeing. The fact that Edmonton and Calgary both appear towards the top of this list on construction and unsold inventory on a per capita basis gives me a bit of a red flag. I'm going to be interviewing Brian Yu from Central One, who came up with a lot of the charts that I put up in this video. I've always really loved his analysis. So stay tuned for that. It's going to be called The End of Homeownership. Are we replacing condos with rentals? Hit subscribe and turn on notifications so you don't miss it. If you want the spreadsheets behind today's charts, check the description or leave me a comment and let me know if I'm missing anything here. I always love, I feel like a lot of you have been really good about leaving me comments, sharing some of the blind spots that I have, playing the devil's advocate, exploring other perspectives. I really appreciate that. So keep doing it. Leave me a comment. I'd love to have a conversation with you. Thanks a lot for taking the time to watch this. It means the world to me. I spend a lot of time doing this. I'm really making an effort. I've been, I think, a lot more successful on other platforms, and YouTube's always been a grind for me. And so I'm just trying to level up. I appreciate the feedback on things that I can do to make my video better. So keep it coming, honestly. Thanks again for taking the time to watch. I hope to see you again soon.